thoughts. I thought it was not even
Hello, everyone.
that necessary.
Okay, goals for today. I want to get through ordering. I'm going to take a step back from where we ended because I felt like we kind of rushed through right at the end last class. So I'm sure we're all on the same page on that. I want to get through that. Then we're going to do non-cash property distributions and then stock dividends. And I'm going to save redemptions for when you're fresh on Monday. So again, we're doing 4 scenarios here, and you just gotta, I'm gonna come back to this slide with the key takeaways because there's only certain things that are really important in each one of those to make sure you fully grasp those. So just backtracking a little bit, and I updated the slides as well, so hopefully I didn't put you back too far on this, but I wanted to clarify to make sure the last 2 examples that we went through make sense. So I redid the wording here a little bit. So if I'm positive current and positive accumulated, my 2 E&P accounts, right, the current year and then all prior years coming into the current year. So first it comes out of current E&P. If I only have a single distribution in the current year, then the only thing I do is take, you get your share of current E&P as your percentage ownership of the corporation. Okay? Because there is no pro rata sharing, because there's only one distribution in the year. Right? That's the first example we go. And then that's all of the current E&P, and then I go through accumulated E&P, but since there's only one distribution, you get your percentage ownership of the corporation times the current, times the accumulated E&P. Right? That's the updated value of the distribution. The challenge in this area is when I have multiple distributions in the year. Because now I'm invoking the rules that say current E&P is shared pro rata to each distribution in the year. So it's not a first come, first serve. Each distribution is going to get a piece of the current E&P. And that's based on the distribution share of the total amount distributed. That's how much we're going to allocate of current E&P to that particular distribution. So every distribution in the year is going to get a piece of current E&P. If my distributions exceed that current E&P, then I'm going to go into my accumulated E&P, and that's the rule where it is first come, first serve. So the first distribution in the year will get a dollar for dollar amount of accumulated E&P up to the amount of the distribution, leaving what's left to the next distribution, leaving what's left to the next distribution. So just applying those principles to the last 2 examples. So this example, we had current E&P of 40 and accumulated E&P of 16. So the first thing you got to do whenever you have an example is, what bucket am I in? Well, positive current, positive accumulated, so I'm in the first bucket, right? And so the company distributed $48,000 to Jacob and $16,000 to Jenny. I added up here, this was a single distribution, right? It was at December 31. So I don't have any of that pro rata stuff. I don't have any of that first come, first serve to accumulated E&P because there's only one distribution. So the only thing I have to do here is Jacob is a 75% owner and Ginny is a 25% owner. So first current E&P goes out, 75% of that goes to Jacob, 25% to Ginny. If there's still an amount distributed over that, then that comes out of accumulated E&P. I don't have to worry about first come, first serve because there's only one distribution. So I get 75% of the accumulated E&P tracks to Jacob, 25 to Jenny, so they get their share of accumulated E&P. And I'm always accounting for 100% of the distribution. It has to come from current E&P, accumulated E&P, return of capital, cap gain. I'm not done until I go through all of that up to the amount of the distribution. So in these examples, Jacob gets 30,000 of the 40,000 current E&P to 75%. Jenny gets 10,000, which is 10% of the current E&P, right? And so the 24,000 distribution in excess of current E&P, because that 64 in total was sent out. 40 can only go out as current E&P, so there's 24 extra. That comes from accumulated E&P in that same proportionate ownership interest. So 12,000 to Jacob, that's 75% of the 24, should be. And 4,000 is 10% of the, let me see if I got that right. 24 distribution in excess of current E&P is paid from accumulating, so accumulating E&P, sorry, is only 16,000. So 75% of 16,000 is the 12. That goes to Jacob. 25% of the 16,000 is 4,000 that goes to Jenny. And then I have still an amount of distribution because I'm not up to the 64 that was distributed, right? So now I go into my second category, is my return of capital, and that's going to depend on each shareholder's basis in their stock. I take that out dollar for dollar. If I go above that amount, then I fall to the third category, which is my catch-all, which is cap gains. Okay? So it's very simple. I have positive, and I have one distribution in the year. It's just all my ownership percentage. The second part of 7.4 is the complexity when I have multiple distribution. I had a distribution in June and December. And the reason now I'm in the pro rata rule for current E&P, and I'm in the first come, first serve rule for accumulated E&P. Because I got multiple distributions in the year. Okay? So here I have to look at the total amount distributed, which was, let me get my numbers here. I had 45 and 15. 45, and Ginny received the 15. So I have a total of 60 distributed, right? I had 45 that went to Jacob, and I had 15 that went to Ginny. And so, of that current E&P balance, which was 40, up here in the facts, 45 over 60 of times 40 is 10,000, or is 30,000. 30,000 of the current E&P goes to the first distribution. Right? It's not first come, first served, it's pro rata, based on the amount of the distribution to the total distribution. And so that leaves 10,000 that goes to the December distribution. Right? And so now I had 45 and I accounted for 30 of it. That means now I have to go to my next step, which is accumulated E&P, and that is first come, first served. So the June distribution takes all the accumulated E&P. Sorry. So that accounts for my $45,000 dividend, and I have no return of capital. Okay. For the December distribution, I had 15,000 distributed. 10 of that was current E&P because I share in that pro rata. But I don't get any of the accumulated E&P because that's already gone. That left on the first distribution, which means then I have a $10,000 dividend because my dividend is only made up of E&P, right? Leaving the incremental 5,000 that I still need to account for as coming out of return capital. So, because Jacob's distribution took place before Jenny's, the distribution, Jacob's distribution 15 is allocated to accumulated E&P, leaving 0 remaining for Jenny. If Jenny is only allocated 10 of E&P, the excess of the amount distributed, 5, has to be a non-taxable return of basis. Her basis comes down from 12,000 that it started, minus the 5 that was distributed on this distribution, 7. So I think the key, if I was going back to this, and I got a positive, the first thing I'd ask myself is, do I have a single distribution or multiple distributions? Single percentage ownership in the current E&P and accumulated. If it's multiple, then I got to deal with the pro rata allocation based on my first distribution of the total. Yes, the first distribution amount for the total distribution. That's going to be the amount of current E&P. Second distribution is the fraction is second distribution amount of the total. Okay, so now moving on to the second bucket. Let's say we're positive current and negative accumulated. Fact pattern you could have there is think startup mode. That's what comes to my mind. I lost a lot of money in the years I was getting going, but man, my idea is paying off now. So first year I made money. So I'm positive current and I'm negative accumulated. Okay? So these are characterized as dividends. So if that company makes a distribution in the current year, the distribution is characterized as dividends with amounts distributed in excess of current E&P, jumping over accumulated E&P because it can't make a distribution out of a negative number. I go straight to return of capital, the extent of my tax basis, then any remainder goes to cap gain. Okay? This is referred to in practice as a nimble dividend. The way I think you can remember that is it's nimble from the perspective that, you know, if you think of something being nimble, it's very flexible, very amenable. But it's nimble because we don't preclude a company from being able to pay a dividend until it's completely positive over time. We want to incentivize companies to pay dividends, right? That gets money out of the corporation, the shareholders, and that's a good thing. If I required you to be overall positive over the lifetime of your organization, that may take some time because you might lose money for 5 years, and it might take you a number of additional years before you overcome those lost years to where you're $1 positive, and then you can only pay $1 dividend. The government didn't want that to be the rule, so we act nimbly in this scenario, meaning that if you are current positive, you can pay a dividend up to your current E&P. Okay? And then, after you exhaust the current E&P, if you have distribution in excess of that, you obviously cannot go to your accumulated E&P because that's a negative balance. You can't make a distribution out of a negative balance. But you still go to return of capital to capital. Okay? So the second bucket, to me, is just think of minimal dividend, meaning I can pay a dividend up to the amount of my current E&P. Even though I have an accumulated deficit. Okay, 7.5, Connor, this for us.
For this one, the distribution to Jacob represents 75% of the total distribution, and the distribution to Jenny represents 25%. So 75% E&P is $45,000. In the second, the 25%, the current E&P would be the $15,000.
And so why do I do that? Because I had a single distribution, right? I had a December 31 distribution. So I don't have to worry about the pro rata rule. I don't have to worry about, I don't have positive accumulated E&P. So I don't have to worry about the first come, first served. But I don't have a pro rata distribution of current E&P. It's just straight ownership.
And then going on to the next, what tax basis will Jacob and Ginny have in their SCR stock after the distribution? And that's that difference. You see that excess, that $3,000 to Jacob, and then that $1,000 to Ginny.
Because Jacob got $48,000, but he only got $45,000 of the current E&P, so there's still $3,000 you got to account for, right? And the next, you've exhausted current E&P, no accumulated E&P because it's negative. Then you go to return of capital. Does he have sufficient basis? Yes, but he has to reduce his basis.
The last question, what is SCR's balance in accumulated E&P at the end of the year, / beginning of next year? SCR has a $20,000 deficit balance in accumulated E&P at the end of the current year, beginning of the next year. And basically, some of the dividend and ROC must equal the total distributed of $64,000 from earlier, the $40,000 to Jacob, $16,000 to Ginny.
And so that balance in accumulated E&P didn't change, right? Because it came into the year minus 20. I made money, but I distributed all of that. So nothing then rolled into the accumulated and lowered the accumulated E&P. So the accumulated E&P deficit is the same as coming into the year. The only way that would go down is if I had current E&P and I didn't distribute all of it, right? Because then it would start eating into it as I rolled into it. Okay? Perfect. So, yeah, I put in the boxes over here. Just make sure you account for all of the amount distributed. Like a good checkpoint is to go back and say, okay, how much did, find the facts, okay, 48,000 to Jacob, 16 to Jenny. Did I account for 48 and 16? In that methodology. But again here, I think you gotta think back. So single distributions, I don't have the pro rata rule. Okay. This is a very interesting example. So this is, again, positive, current, negative, accumulated. So this company, Visteon, sold a subsidiary at a pre-tax gain of $2.3 billion. Pretty large gain. The sale was completed in 2015. Visteon's net cash proceeds from the sale were about 2.7. Visteon then announced a plan to return 2.5 to 2.75 of cash to shareholders, and it actually distributed 1.75 first part of next year. We got a calendar year taxpayer. 15, I had the transaction that created a big gain, right? I didn't make the distribution until 16. So this blurb here is asking why did they wait? Okay? Is there a tax reason why they may have waited? One possibility is that it had a large deficit in accumulated E&P at the beginning of 2015. So that they might have been in positive current because I had a life event. I sold something and had a big whopping gain, but I had lost money over time. So I like to think of it, maybe it's a startup, has something valuable, but it's not yet making income, but it's valuable in the marketplace, so I split, triggered a big gain. But I still got this problem, I was in a startup and I lost a lot of money, so I have negative accumulated. So, the gain on the sale created a significant balance in current E&P. Recall that distributions are dividends to the extent of current E&P, even when there is a deficit in accumulated E&P. That's the nimble dividend concept we just went through. So, Visteon's special distribution in 2015 would have been characterized entirely as a dividend to its shareholders. Right? It had a gain of 2.3, and if it distributes 1.75, that's the rule we just went through in that Connor's example. That's a current E&P distribution, dividend income. Okay, taxable income. If it's individuals, you guys remember it's 0, 15, or 20 is the tax rate. Now, what happens if they wait to make the distribution until 16? It would be characterized entirely as a dividend. However, by waiting to 2016 to make the distribution, it is possible that a significant portion of the distribution was treated as a non-taxable return of capital to shareholders instead of a taxable dividend. What happens when that current E&P stays in the corporation and then I go to the next year? It gets added to the negative accumulated E&P. If the negative accumulated E&P is greater than the current E&P in the next year, then I don't have any E&P, which means my distribution cannot be a dividend. If I have sufficient tax basis, it could all be a return of capital to my shareholders. So I gave in collection $1.75 million as a non-taxable return of capital, assuming there's basis in the stock of a piece of that for all the shareholders. Instead of $1.7 billion of a dividend taxed at 0, 15, or 20. Some of my shareholders are high income and they're 20% shareholders, so I saved them a bunch of taxes. Now, there's nothing untoward about doing that. If that's their facts, I think they're posing this as that maybe is the reason they waited. To me, that's being well advised, and there's nothing in the rule that is subjective. It's all objective. Current E&P in the year, but if you don't do anything, then at the start of next year, stroke of January 1st, it becomes accumulated E&P. So you get added to that. So that's just good tax stewardship, if you ask me, on doing this transaction. And somebody probably raised their hands like, I don't remember we talked about current and accumulated E&P in tax class. Maybe we should wait. But somebody probably raised their hand and said, we need to think about this and see if it makes a difference between doing this in 15 and 16. And that was the facts that clearly made a huge difference to the show. Okay, so, right, we have two variables and we have combinations, we can only have four options. So our third option is, let's say I'm negative current, but I'm positive accumulated. Think of what fact pattern that might have been. What about when the pandemic started? I might have been profitable in my prior years, and then all of a sudden my sales dried up. 2020, and current year loss. Okay? That's why it could be just third bucket. So, in scenarios where current E&P is negative, the characterization of a distribution is determined by the amount of the available accumulated E&P projected as of the date of distribution. That's the key in this third bucket. I have to advance my accumulated E&P from the beginning of the year to the date of distribution. I'm going to allocate some of my negative E&P against my positive accumulated. I don't say it doesn't touch it. This is my one allocation. So negative E&P must be allocated to accumulated E&P up to the distribution date to arrive at available accumulated E&P as of the date of the distribution. Distributions in excess of that number of available accumulated E&P, then I jump to returning capital, the extended basis. Anything in excess of that goes to the catch-all of capital gains. And that all is obviously going to depend on the amount of the excess and the shareholder's tax basis. The recipient has the shares of the corporation. Okay, so I've lost money currently, but I made money in the past. So now what I have to do is advance some portion and eat into that accumulated E&P for that current year loss. Okay, 7.6 is Ethan.
Assume SCR reported current negative E&P of 20,000. However, the balance in accumulated E&P at the beginning of the year was 60,000. On July 1st, SCR distributed 48,000 to Jacob and 16,000 to Ginny. Jacob has a tax basis in an SCR stock of 24,000, while Ginny's tax basis in her SCR stock is 10,000. What amount of dividend income to Jacob and Ginny report? They would report 37,500 and 12,500 dividend income. Because current E&P is negative, SCR must determine its available E&P on distribution. SCR prorates the full year negative current E&P to June 30th. For the negative current E&P of 10,000, subtracted from the balance in accumulated E&P of the date prior.
So they were just assuming that the negative E&P accrued kind of pro rata through the year. So for 6 months into the year, so half that loss, you advance that, that would be my accumulated E&P as of the date of distribution, right?
Prior to the distribution of 60,000, I compute the available accumulated E&P as of the day end of June 30th of 50,000. Because the distributions were made at the same time, Jacob has allocated 75% of the total E&P, totaling 37,500, and Ginny has allocated the remaining 12,500.
So that's that rule we started with. That's a single distribution, right? So I don't have a pro rata problem here. I just have ownership percentage of the available earnings.
What tax basis do Jacob and Ginny have in their SCR stock after distribution? That will be 13,500 for Jacob and 6,500 for Ginny. The amount in excess of available E&P, which is 10,500 to Jacob and 3,500 to Ginny, is treated as a return of capital. Jacob reduces the basis in his SCR stock to 13,500, and Ginny reduces the basis in her SCR stock to 6,500.
And I'm there because I've fully exhausted the accumulated E&P as of the date of distribution. 50,000 went out, so there is no more E&P, right? So I have to go to my second category, which is my return to capital, and all depends on do I have sufficient basis and stuff. Okay.
Finally, what is SCR's balance in accumulated E&P at the end of the year? Negative 10,000. Since distribution in excess of an available E&P doesn't reduce E&P because it will generate deficit in E&P, only allows to produce deficit in E&P as follows. With an accumulated E&P beginning up to 60,000 minus a prorated negative of 10,000, the dividend distribution of 50,000, and the prorated negative current of 10,000.
so I think that's important as well, because it kind of rounds out what you just did. So I started with 60,000. I advanced it from the beginning of the year to the date of distribution. So I added another, all right, subtracted 10,000 that I lost in the first 6 months. So now I'm down to 50,000 of accumulated EEP. When you went through the example, I distributed all that, right? So that EEP is gone. That's the 50,000 that went out the door. And then I lost, had a very bad year. I continued to lose the second half of the year. So I had another 10,000. So I start to be, my accumulated E&P as of the beginning of the year is minus 10,000, right? Okay. So the whole trick here is just to determine accumulated E&P as of the date of distribution. I don't do that in any of the other examples. That's just because I have a negative current, positive accumulated. Okay. And lucky for us, number 4 is very simple. The only other possible scenario we have is I'm just good old-fashioned negative current and I'm negative, right? So probably started early or chronically just my business is not doing well. But now I have no E&P. So this one's super simple. Can't have a dividend if you don't have E&P, right? So none of the distribution will be characterized as a dividend, so I automatically jump to return to capital to the extent of the recipient's tax basis, and then my catch-all is cap gain and distribution above that. That example 7.7 is Claude.
What if assume SCR reported current ENP of -50,000. The balance in accumulated ENP at the beginning of the year is -60,000. Jacob has a tax basis in his CSR stock of 24,000. Ginny's tax basis in an SCR stock is 10,000. On December 31 of this year, SCR distributed 38,000 to Jacob and 16,000 to Ginny. What amount of dividend income do Jacob and Ginny report this year? So the answer would be neither Jacob nor Ginny recognizes any dividend income from this distribution. And that's because the current EMP and accumulated EMP are negative. The entire distribution would be treated as a return of capital / capital gain. So will Jacob or Ginny recognize any capital as a result of this distribution? And what is the tax basis in the CSR stock for Jacob and Ginny at year end? And so the answer to this would be that Ginny has a capital gain of 24,000, and the amount by which the distribution exceeds the tax basis in his SCR stock, that is 48,000 less 24,000.
So I have to get to 48, right? And I have basic, I don't have any E&P is 40, so that's 0. Then I go to my next category, return capital, I got 24, so I knock it in half, and then that extra 24 is going to be kept.
Ginny has a capital gain of 6,000. The amount by which the distribution exceeds the tax basis in an SCR stock, that is 15,000 less 10,000. Both Jacob and Ginny have a 0 basis in their SCR stock at the end.
And that's for all purposes. I don't have any more basic, I just took it away. So if I subsequently sold this stock, ignore the fact that this thing's just losing money currently and in the past, if I could sell it and I had a gain, or if I couldn't sell it and I had an amount realized, I have no basis. So it's entirely capital gain at that point. I recovered my basis on a distribution, so it's no longer there.
And you have to know that the sum of dividend, ROC, and capital gain must equal to the total distributed of 64,000. That is 40,000 to Jacob and 16,000 to Ginny. And the third question: what is SCR's balance in accumulated ENP at the end of the year? Answer is a negative balance of 110,000. That is the sum of the accumulated ENP deficit of 60,000 plus the negative current ENP of 50,000.
Yeah, so that just right, I came into the year with a negative accumulated EMP of 60, and I continued to do bad. I added 50 to it, so my accumulated EMP going into the following year is going to be the sum of those two, 110,000. And so think about what would happen the next year if for some reason this company could distribute more money. I have no EMP if it loses. I have the current year EMP deficit next year. And I have no EMP, I have no basis, everything's cascading. Now, I think you have a practical limitation here, right? Companies cannot continue to lose money and make distributions to owners. Eventually you need cash, right? Losing money needs to be funded. And so there's a practical limitation of how much can be distributed in the business. Okay, so if I were going back, trying to wrap my head around what this is, right? I got 4 possible scenarios. The first one is we started with, what's important to think about there? Do I have one or multiple distributions? But I'm gonna, and then if I have multiple, I'm gonna go pro rata, that's the second part of 7.4, out of current ENP, and then I dip into accumulated ENP first come, first served. I got multiple distributions. I have a single distribution, it's just ownership percentage. I don't care about pro rata. The second category, positive current, negative accumulated, that's the nimble dividend. Startup mode, now I turned a corner and made money, I can pay a dividend out of that current ENP. Right? Third one, negative current, positive accumulated, think pandemic. Profit low and then the world stopped. Only thing I have to do there is prorate that current EMP, that negative current EMP up to the date of distribution. And then that comes out. Okay. And negative, the easiest one, I don't have any dividend, I go straight to return on capital. Okay. And 7.3 is a nice example too. Okay. So that is the ordering rules for distribution. Okay. Now we're going to talk about non-cash property distributions. So most distributions from corporations are made in cash, right? Especially in the publicly traded scenarios. Apple cannot give a zillion shareholders property other than cash. It's just not practical, right? So in the publicly traded setting, you're going to see lots of cash go out. In a more closely held, more family-owned corporate setting, founder setting, there can be non-cash property distributed, right? Because I don't have that practical issue of having a million shareholders. Right? So I may distribute a piece of land, I might distribute a piece of equipment, something like that, that shareholder will take instead of cash, right? So it is possible to make a distribution other than in cash, particularly in a non-publicly traded situation. The ordering rules and the characterization rules, the evaluation of current EMP, accumulated EMP, then return to capital, then cap gain, that we just discussed apply equally. Nothing special, right? That's all premised on value. Just all those examples happen to be cash, but that could have been a piece of land for that. And so we still have 4 scenarios. Current, positive, negative, positive, negative, negative. Still happen in a non-cash property distribution. When I do have non-cash property, I add 3 additional areas of complexity to what we just talked about. Because I don't have gain or loss issues with cash, right? When I'm dealing in US dollars and I'm a US taxpayer, I don't have gain or loss in cash. My US dollar cash. This I do have gain or loss in because I'm dealing with non-cash property. So that's what adds the element here. So first I have to determine the amount distributed, right? It's much easier to do with cash, so just know what it is. But any liability that is associated with the property that the shareholder assumed decreases the amount distributed. Okay, because I'm looking at net value. If I would give you a piece of equipment worth 1,000, you you'd have a dividend of 1,000 if I didn't. If I gave you a piece of equipment worth 1,000 that had a $200 liability associated with it, net, you only got 800, right? So that possibility of sending non-cash property that would have a liability associated with it can put a little noise into computing the amount that was distributed. And you also have to do evaluation, right? So like, if I'm distributing a piece of equipment to an owner, what's the value of that equipment? That's not as readily ascertainable as if I give you $1,000. So one, I got an evaluation exercise I gotta kind of think through. Then is there any liabilities associated with that that would be netted against the value of the property? Corporations and shareholders suffer taxpayers, right? Corporations are separate taxpayer. If there's a difference between fair market value and the corporation's tax basis in the property, particularly if there's a gain, the gain will be recognized when it leaves the corporation, right? The corporation, being a separate taxpayer, can't take asset that it has a gain in and distribute it. It would pay tax on that just like if they sold it for cash to a third party. Right? It's its own taxpayer, it's its own tax return, own tax responsibilities. So that can result in current income tax implications. That's different than cash, right? Because again, I don't have gain or loss in US dollars. Then the E&P implications of the distributing the non-cash property. Again, any difference between the fair market value and the tax basis in the distributing corporation has in that property affects the calculation. I think this is the most complicated part of this subject matter. That third component. We'll kind of go through that, and I think I got a few slides kind of that'll help you understand what that means. But first, I got to determine the amount distributed, which is more difficult than that, and I have gain or loss that I got to deal with, and then I got E&P. So, taking those in order. So determining the amount distributed. So it's going to be the cash distributed plus the fair market value of non-cash property less any liabilities assumed. That is the amount distributed. Okay? So I could have a cash and non-cash distribution that has a strong ratio. And I may or may not factually have a liability assumed by the sheriff. Okay? I think you'll see the liability assumed if I had real estate. So there was land in the corporation that the corporation wasn't going to use, but the shareholder was going to use it. Lots of times you see that associated with land on a recourse basis. So if I send the land out, I might send the loan with the land. So you get the net value. But that's what we're going to be talking about here. But it's technically cash distributed, fair market value of any non-cash property, and then subtract any liabilities. That's going to be your amount. What's interesting is the recipient shareholder takes a tax basis in any non-cash property distributed equal to the fair market value of the property. That's because getting the non-cash property out of the corporation is a taxable event, especially if it's appreciated. And that means tax has already been paid on the gain in the asset, so that means the new owner, the shareholder, takes a fair market value basis in the asset. It's only subsequent appreciation or depreciation in the asset that will affect the gain. Okay, 7-8. Esmeralda.
Assume that rather than distributing $60,000 of cash to Ginny, SCR distributes $15,000 in cash and a Fuji custom touring bike that has a fair market value of $1,000. Suppose that SCR has current E&P of $100,000, including the impact of the distribution on current E&P, and no accumulated E&P. What amount of dividend income will Jeannie report this year?
So they just put 100,000 to make sure that it's very outsized, right? We have plenty of E&P to support the distribution. It's just getting to the values that were distributed, how much of that?
Answer is $16,000. Jeannie would include $15,000 plus the $1,000 fair market value of the bicycle in her gross income as a dividend.
Right, as this prior slide, all value going out of the corporation received by the shareholder would be the amount distributed. And I go through what we just went through the first part of class. Do I have E and P to support that? Yes, I have a vastly amount of E and P, so all of that would be a $16,000.
What is Ginny's tax basis in the bicycle she received as a dividend? Answer is $1,000. Ginny has a tax basis in the bicycle of $1,000, the bicycle's fair market value.
And the way to think about that is, she got the bicycle in a taxable transaction, right? She paid tax and the dividend income of the incremental $1,000 of value distributed. So she should get basis. Whenever you have somebody who pays tax on a transaction, you get resulting basis in the transaction. So she didn't get this for free. She got this for the cost of taxable income, tax line. So that's the premise as to why you get tax basis. Tax property. Yeah, thank you. Okay, 7-9. Megan.
So in this example, we're assuming that instead of distributing $48,000 in cash to Jacob, STR distributes a parcel of land that they previously purchased for $60,000. The land has a fair market value of $60,000 and a mortgage of $12,000 attached to it. Jacob assumes the mortgage on the land. Suppose that STR has current E&P of $100,000 and no accumulated E&P. How much dividend income does Jacob recognize on the distribution? So the key thing in this problem is the assumption of the mortgage of $12,000. So he's going to recognize $48,000 of dividend income, and that's the land's fair market value of $60,000 less the assumption of the mortgage, which gets us $48,000.
Yeah, because the net value I got was 48. Right? I have to pay off the debt.
And then his tax basis in the land is just the land's fair market value of $60,000, which we can further break down into a $48,000 taxable distribution and then his assumption of the $12,000 of debt.
Yeah, so I mentioned as to the prior example, why did you get a fair market value basis of $1,000 in the bike is because you had $1,000 of income. Well, here you only have $48,000 of income, but why did you get a $60,000 basis? Well, I did assume $12,000 of debt. So in order to have basis in the debt, I have to have basis in the asset. The way I like to think about that is, let's say there was no distribution and Jacob just went out and wanted to purchase land for $60,000. If the way he funded that was I take a loan of $12,000 and I reach into my pocket and pull out $48,000 to get to $60,000, deliver that to the seller and buy the land for $60,000, I would have basis of land in $60,000, right? Because I incurred debt to acquire it. So I get basis in the asset when I borrow money. That's the same effect. Okay, perfect. Thank you. Okay, so that's the first thing. Determining the amount. So I have the valuation aspect, like I have to value the real estate and the value of bike, that type of thing, but that is what it is. Get that done. The nuances is whether there's liabilities associated or not. You're not going to be based on distributed cash. Okay? So then the second complexity when non-cash property distributions, dividends are done, is the corporate level tax implications of distributing those assets. Right? If it's cash, the corporation doesn't have gain or loss in cash. If it's property, yes, I have gain or loss in property. When a corporation distributes non-cash property, gain is recognized. So this is a one-way street. I recognize gain by the distributing corporation to the extent the fair market value of the property exceeds the corporation's tax basis in the property. That calculation is no different than if I had sold the property. So what the government doesn't want you to do is avoid, so let's say I had a different result if I distributed non-cash property. What I could do is I could sell the property, recognize the gain, generate the cash that pays the dividend. But instead of doing that, I just distribute the property to you. The government wants the corporation to recognize the same gain in both transactions. Because the asset is in the corporation, it appreciated, and it's no longer there. tax effective, is leaving a separate taxpayer. So whether you sell it or you distribute it, it's no longer there, you have a built-in gain in effect. It's a one-way street here. If there's a loss in the property, the loss is not deductible. Okay? And I think this is just probably premised on the fact that it has the connotations of a related party transaction if you're distributing it to a shareholder, even though you technically might not be a related party. But the way they wrote the rules is gain is recognized, loss is not recognized. Okay? But I still have an effect on the corporation. I don't have that when I have cash. Okay? So again, this is where just taking a moment, and if you see this on an exam or something I talked about at the first starting class, just understand the facts, quiet down. Did I do cash? Did I do non-cash? Make sure you get your facts kind of lined up. What's my E&P? What's my dates? That type of stuff. So don't start immediately trying to answer the question. You get lost in trying to answer the question without settling down and understanding the facts. So, gain is recognized, loss is not deductible. Okay, 710 is Eugene.
The first what if says, assume SCR has an adjusted tax basis of $650 with the Fuji custom touring bike for both income tax and E&P purposes, then distributes to Ginny.
Let me pause you there. That parenthetical for both income tax and E&P purposes. I don't think you need to read this example because I think SCR is in the biking business or something. But remember, for tax basis for E&P purposes, it's straight line, and tax might have accelerated depreciation. But if this is inventory, you can't depreciate inventory anyway. So I don't think that's a relevant factor. But that's what that means. Why for E&P tax purposes, one straight line and one accelerated.
So I just want to find how much taxable gain, if any, SCR recognizes when it distributes the bicycle to Ginny. And recall that the fair market value of the bicycle is $1,000. So we see that SCR recognizes a taxable gain of $350 on the distribution of the bicycle to Ginny, which is the $1,000 minus the $650. And because the bike is considered inventory, SCR would characterize this gain as ordinary income. And the corporate level tax of $73.50 on the gain from the distribution, which is the 21% times the taxable gain, would increase SCR's federal tax liability.
Yeah, so that's just saying, if they would have sold this, that's the exact same result that would have happened, right? I sold a bike for $1,000. I have cost of goods sold of $350. The delta's taxed at 21%.
Now we want to assume that SCR has an adjusted tax basis of $1,200 in the Fuji custom touring bike that it distributes to Ginny. The bicycle's fair market value has declined to $1,000 because it's an outdated model. In this area, we want to find how much loss, if any, does SCR recognize when it distributes the bicycle to Ginny. And we see that they're allowed to recognize $0 because SCR is not permitted to recognize a loss on the distribution of the bicycle. And then the final one is, suppose SCR sells the bicycle to Ginny for $1,000. How much loss, if any, can SCR recognize if it sells the bicycle to Ginny? And we see that they're permitted to recognize a loss on the sale of property to a shareholder, provided it does not run afoul of the related person loss rules found in S 267. Related person and Ginny must owe more than 50% of SCR, which does not in this scenario, so we're able to recognize 200.
So the difference between the last two what ifs, one was a distribution, and the rule is just flat, you cannot recognize a loss on the distribution of built-in loss property. So its basis was $1,200, but the value was only $1,000, so it had a loss in it. And then the last one is saying, well, what if instead of distributing it to Ginny, I sold it to her? Meaning I didn't, remember a distribution, you get nothing in the exchange. A sale, you're selling it, you get paid for that, right? So I sell it to her for $1,000, she gives me $1,000. I can, as a corporation, recognize that loss so long as these related party loss rules are found in 267. And that means that I have to be a substantial shareholder in the corporation. She's a smaller shareholder, which I think, going back to those earlier examples, she was a 25% shareholder, so she's less than the 50% required to related to the recognition. Just the distinction on how you structure this. Okay, so corporate level implications, be on the lookout for gain recognition. the amount of any liability assumed by the shareholder and whether the liability is less than or greater than the fair market value of the distributed property can affect the amount being recognized. So this is an added complexity here. If the liability assumed by the shareholder is less than the fair market value of the distributed property, the gain recognized by the distributing corporation remains the excess of fair market value over the corporation's tax basis. The liability assumed by the shareholder does not impact the gain computation. So your normal amount realized less adjusted basis is the computation. In the rare fact pattern where the liability assumed by the shareholder is greater than the fair market value of the distributed property, the property's fair market value is deemed to be the amount of the liability assumed, increasing the amount of the gain recognized by the distributed corporation. So if I had borrowed money and it's associated with the asset, and the asset has declined in value, where I owe more than the asset is worth, and I distribute that to a shareholder, and the shareholder agrees to accept that, then the shareholder is going to deem the value distributed to be equal to the amount of the debt, the principal amount of the debt. I think this is a practical situation as well. Would I accept anything that would have more liability associated with it than value? I'd be like, that's a terrible deal for me. I'm like stepping backwards. I'm taking on debt, net debt. So they deem it in that situation to where the land or the property might be worth the amount of the liability if somebody were to assume that. And this also helps with the corporation because the corporation is actually relieved of the liability. Right, so we need to account for that extra value in the form of I have less liability on my balance sheet, which is a good thing for the corporation. So that's another reason why they need it to be the value of the value equals the amount of liabilities. Okay, we'll do that in 7-11. Joe.
Alright, so assume Jacob receives a parcel of land previously purchased by SER for possible expansion. The land has a fair market value of $60,000 and the remaining mortgage $12,000 cash flow. SER has a tax basis of $1,000,000 and $20,000, and Jacob assumes the mortgage on the land. How much gain, if any, does SER recognize when it distributes the land to Jacob? The answer on this one's $40,000 because the mortgage assumed by Jacob is less than the land's fair market value. SER recognizes gain in the amount value over its tax basis.
So that's no different than if I sold it, right? I had my amount realized less my basis. That amount is crystallized, recognized when I make a distribution just as if I was sold.
Now assume the mortgage assumed by Jacob is $75,000 instead of $12,000. Land has a fair market value of $60,000. The SER has a tax basis in the land of $20,000. Jacob will assume the mortgage on the land. How much gain, if any, does SER recognize when it distributes? So this one is $55,000 because the mortgage assumed by Jacob exceeds the land's fair market value. SER treats the land's fair market value of $75,000 and recognizes gain in an amount equal to the excess of the mortgage assumed over its tax basis.
Yeah, and so again, the reason to understand the rationale behind this is because I would have recognized $40,000, right? If it was below, but now I am above value of the land. So I need to account for that excess of the value received by the corporation of not being liable for the liability anymore. So when that asset leaves, that extra liability reduction that I have has to be counted as amount realized. It's effectively tax catching up with the economics.
This figure as well. Because the mortgage exceeds the value of the property, Jacob is treated as receiving a distribution of $0 and will take the basis of $75,000.
Yes. And if Jacob wanted to, so he's got a basis of 75 and an asset that's worth 60, right? He could crystallize that by selling that to a third party, right? An unrelated party. But we have to. It's just that liability, and think of it in terms of economics, that liability is left the balance sheet of the corporation. That's why they deem there to be a higher fair market value. So now we're to the third complexity in non-cash property distribution. And this is the E and P implications of what we just did. Okay? Distributing property, non-cash property out. And the way this will only make sense to you is if you compartmentalize current E and P and accumulated. Okay? So we're going to first start with current E and P. So if I recognize gain in the transaction, so we had a couple examples where we recognize gain, we distributed out appreciated property. If I recognize gain, current E and P is increased for any gain recognized by the distributing corporation. I think that's intuitive, right? If I have a built-in gain asset and I realize it, and I recognize it, that has to go into my current E and P. I recognize the total value of that. So I have the gain increases my current E and P. What happens when I have a gain? I pay tax. So the second item, my current E and P is decreased by the amount of tax I pay on the gain. So that's the net, right? That's the net effect of current E and P. Yes, I got a gain, but it's not non-taxable. It's taxable, so I have a net. I get to keep a net portion of the gain. And remember what E and P is trying to measure: my economic ability to pay a dividend. So it went up and it went down a little. Went up and it went down by 21%. Okay? And current E and P is not decreased for the distribution of property where the tax basis in the property is greater than fair market value by built-in loss. Right? If I'm not recognizing the loss, then I do not have a current E and P effect because I haven't recognized it. So I think the current E and P of looking at it makes sense. The accumulated E and P is a little more hairy. But current E and P goes up for the gain, down a little for the amount of tax I pay because I got to give that portion to the government. Current E and P doesn't move when I have a loss because the loss is not recognized. Now when I look at the accumulated E and P effects of that property distribution. So to reflect that a distribution reduces a corporation's economic resources to pay dividends in future years, a corporation needs to reduce its accumulated E and P upon a distribution of non-cash property. Right? It's no longer there. Remember, this is a one-sided transaction. I make a distribution, the value's gone. So my economic ability to pay a dividend has went down. The property that I used to have is no longer there. Okay, so the amount of that reduction depends upon whether the distributed property has appreciated or depreciated relative to the corporation's tax basis. So if it, for accumulated E and P, it is reduced by the fair market value of appreciated property distributed by a corporation. Because that value is no longer there. It cannot economically support a distribution in the future. So I have to lower the amount of my accumulated E and P. So if I couple that, when I look at total E and P, these are the two things that increase E and P, right? So if I had appreciated property that was non-cash that I distributed out, my total E and P effect, and I think this logically makes sense, I increase it by the gain because I've recognized that appreciation. I lower that a little bit by the tax I pay on the gain because that cash goes out the door. And then I reduce it for the full fair market value of the property because I just gave you the property, it's gone. I have to account for that I can't give that value again. Right? So up by the gain, down by a little bit of the tax, all the way down by the fair market value. That's the total E and P. It's just broken out between current. That helps you when you think about lost property. Because when I look at current E and P, we just talked about, I didn't recognize it, so I don't reduce E and P for the current loss. My accumulated E and P on the distribution of depreciated property is the tax basis, is the amount that I reduced my current E and P. That one is not as intuitive. The reason you have that is, again, think of it from a total E and P perspective. Okay? If my tax basis is at 125 and fair market value is 100, I have effectively, I need to have 125 reduction in my total E&P. Why? Because 100 of value went out, plus I lost 100, or I lost 25. Because its value went down from when I acquired it. So I need a full reduction of 125, that's my tax basis. Right? And I don't have any current E&P effects because I don't get to recognize it. So when I get to accumulated E&P, I have to take it down by a tax basis. So you can either choose to remember these rules by the reasoning that I just went through, as to looking at it in total from current and accumulated aspect, or you can use the rule in the bubble. Accumulated E&P is reduced by the greater of fair market value of tax basis. If fair market value is the higher number, then you're in the first item here. If it's the second number, you're in the, if tax basis is higher, then you're in the second. You don't have to worry. Sometimes rules of thumb can get you to the answer shortcut without having to do the mental gymnastics of understanding why that is the rule. That's why the rule is what it is. You have to look at them in total and account for the economic impact on the ability to pay it. Okay. When a shareholder assumes a liability associated with distributed property, the amount of the liability assumed increases accumulated E&P. Why does that make sense? Because my economic ability went up because now my assets are less leveraged. Right? A liability leaves the balance sheet of a shareholder and or from a corporation goes to a shareholder. Now I have, by definition, I have a dollar for dollar increase in my economic ability to pay a dividend because I have less debt. I have more unencumbered assets. Okay. So that would also be, if that liability was in there, I'd have to make that adjustment as well. Increasing. Okay. 713.
What if assume the same facts in SDR distributed to Jacob that has fair market value of 60K and a remaining mortgage of 12K attached to it. SDR has an income tax and adjusted tax base in the land of the land.
So let me pause you there. It says income tax and E&P adjusted basis. It's land. Again, I think that's extra information. We know land we can't depreciate, right? It's never depreciable, so your basis is going to be the same for E&P and income tax.
Jacob has assumed a mortgage on the land. SDR has current E&P of 100K, which includes the net increase of 31.6K from distribution of land, 40K being less related tax liability.
So that's just the first two parts of this. Right? It goes up by the gain, down by the incremental tax I incur on the gain. So they just netted it to the 31.6. So if I have a gain of 40, I got to pay tax of 8,400, which is 21%.
And accumulated E&P at the beginning of the year of 500K. So we're seeing now what is SCR balance and accumulated E&P at the end of the year as a result of distribution of the land. So in the previous slide, we talked about like the integrator of FMV for tax property of the property distributed. In this case, the current fair market value of the property is 60K, and the tax base is 20K, so we integrator is 60K. And then from the beginning, like it will be from the beginning of the year, the accumulated E&P is 500K, and then the current year E&P is 100K, and then we deduct the fair market value of the land distributed is 60K. And then finally, in the last slide, we say that when a shareholder assumes a liability associated with distributed property, the amount of liability assumed increases the accumulated E&P. So in this case, the liability is 12K. 12K of mortgage, so in this case, we have house property.
Yep. So feel free to use the rule of accumulated E&P is reduced by the greater of fair market value or tax basis. Again, I would put on my economic hat here as well. I came into the year with 500,000. I made money of 100,000, which included the impact of that gain, net of the tax on the gain on the land. So that went up 100,000. I gave Jacob land of 60,000, so obviously my economics went down by 60,000. But Jacob decided or agreed to take on a liability associated with that land, so that goes back the other direction, that goes up. That's a good guy of 12,000 from an economic standpoint. So I go for 500 and 550. Okay. That's it for non-property, non-cash property distribution. Think of what's going to happen from a corporate income tax perspective, and then what happens to E&P. Last topic for today, and this one's super simple. Stock dividends. So stock dividends, rather than distributing property, cash or non-cash, right? What we just went through, to its shareholders, a corporation may declare a stock dividend, distributing additional shares of stock to its existing shareholders. So a stock dividend is, I declare a dividend, but it's payable in the form of additional shares. Again, it's one-sided transaction. The corporation doesn't get anything. All they do is deliver more shares. Okay? This is sometimes can be referred to as a stock split, but where the number of outstanding shares is increased by the ratio of the split. It has a similar effect to a stock dividend. So if you have a 2-for-1 stock split, that increases the number of shares outstanding by 100%. So for every 1 share you have, now you're going to have 2 shares. That reduces the market price per share by half. Okay? Because everybody agrees, right? A stock dividend doesn't change the value of the corporation. It's just paperwork, how much value is spread across how many numbers of shares. So all it does is affect the value per share. Okay? The historic rationale, so you'd say, why do companies do this? Why do they do stock splits? There has been a rationale, and I put historical here, behind a stock split is that lowering the price per share perhaps makes the stock more accessible to a wider group of investors, because typically investors like to buy in blocks of stock, so a 100-share lot of stock becomes less costly, right? You've seen some share prices. I think Berkshire Hathaway is one of the famous ones that has never split. It just keeps going up, and I assume, I don't think that split. So it's like hundreds of thousands of dollars per share. I can't buy 100 shares of that, right? So most people like to buy 100 shares or 1,000 shares. So if the price per share comes down to $25 a share, $50 a share, $100 a share, it's much more digestible for a wider number of shareholders. Now, I put historical there because technology has handled all of this. You can buy fractional shares on any platform now. So it's not as big a deal. If you have $10,000 to invest, you can buy $10,000 of stock, and you'll just get a fractional share to get it math work to be $10,000. Now, still, there are some people in the marketplace who still think people like to buy a set block of shares. So if there is still some people who believe that maybe a stock split means something, but certainly does not change the economics of the corporation. The market cap value of the corporation is exactly the same. So there are tax consequences, though. Pro rata stock dividends and stock splits do not provide any accretion to wealth, because your value is just spread across multiple shares. What it does do, it doesn't generate taxable income. Okay, so since the accretion of wealth to the shareholder, that's the premise why the government does not tax a stock dividend. They treat it as a non-taxable event. Right? Your value that you had before the transaction is exactly the same after. It does not look like an accretion to wealth. It doesn't look like anything you should tax. Okay? However, you must spread your existing tax basis for the pre-distribution stock across all the shares you now own post-distribution. Right? So your tax basis, if I had 100 shares of Apple, and Apple gives me a stock dividend, I have to take my basis in the 100 shares and spread it across all the shares I own. Because the value of the shares went down per share. Tax basis goes down per share. But my net total, fair market value and total basis is exactly the same. Okay? It's just that that old basis doesn't stay with my pre-stock dividend shares. Right? Okay, 714. I think build on that a little bit. Esmeralda.
Jacob has a tax basis in his SDR stock of $24,000. Jenny's tax basis in her SCR stock is $10,000. Jacob owns 75 of the 100 shares of outstanding SCR stock, while Jenny owns the remaining 25 shares. Assume that SCR declares a 100% stock distribution. As a result, Jacob will own 150 shares of SCR stock and Jenny will own the remaining 50 shares. Is the stock distribution taxable to Jacob and Jenny? No, the stock distribution to Jacob and Jenny is non-taxable because it is made pro rata to the shareholders. That is, the distribution did not change their proportional ownership of SCR.
So what they owned before, they still own after. It's just spread over multiple shares of stock.
What is the tax basis of each share of SCR stock now held by Jacob and Jenny? Jacob's original tax basis of $24,000 is divided among 150 shares. Hence, each one of Jacob's shares has a basis of $160. Jenny's original tax basis of $10,000 is divided among 50 shares. Hence, each one of Jenny's shares has a basis of $200.
So nothing's happened from a tax perspective, from a current tax inclusion perspective. I do have a basis adjustment I have to do. So again, it kind of begs the question, what is the point of this? And I think most stock analysts would say it's very little. Maybe just that attractiveness of having a stock price that looks something more rational than a $200,000 stock price. And there's nothing magical about a 2-for-1. Sometimes there's 10 for 1, 5 for 1, whatever, to reduce the stock price per share. Okay. Yes, comments?
When the stock splits and they have to and they basically have to change, the spreads change because of it, how exactly would you treat that income from the spreads? Would it be ordinary business income? Or would it be something else?
So help me with the spreads. What do you
Like the bid and the ask spreads, if for the traders, let's say they're making the market,
Yeah.
and it changes because the stock changes, they have to change their quotes. How, when they get their money from the spread, would that be taxes like ordinary income, or would it be something else?
No, I think it would be the same effect before and after the split, just the amount would be different, depending on the number of shares. So that's where it is. So all you're doing is just dividing the same transaction, because nothing should really change. And that's the premise behind why there's not a taxable event. Because the value is the same. Like just magically saying, oh, I used to have 100,000 shares, now I have 200,000 shares. The value of your organization, your business did not change. Right? Nothing changed operationally. You didn't get a new customer, you didn't create a new product, none of that stuff happened. So it should just be spread across multiple additional shares. Okay, the one aspect to be aware of when you have stock dividends is if there's a non-pro rata distribution, meaning disproportionate, meaning some shareholders get cash, some shareholders get stock. Okay, and this might be elective, where the corporation say, hey, here you go, you can choose to get more shares or you can choose to get cash. That will become a taxable dividend. And the reason why is because everything we just started talking about for the last 10 minutes no longer stands, because now amongst shareholders the value has been made disproportionate. Because those that don't accept cash now have more shares, which means they have more ownership percentage in the corporation. If the one shareholder assumes or chooses cash, then their amount of shares is locked, right? They didn't get additional shares. So now they have same amount of shares over a company that has more shares outstanding. So you have to watch out for non-pro rata non-pro rata distributions in a stock dividend. And that will can cause you to have a taxable dividend. So our last example, 715, is Esmeralda.
Assume that SER declares a 10% stock distribution, but offers Jacob and Ginny the choice between more stock or a $100 per share in cash. Is the distribution taxable to Jacob? If he elects to receive 15 shares of stock worth $1,500. If Jacob has received a taxable distribution, what is the character of the income? Yes, Jacob is taxed on $1,500, the fair value of the stock, because the distribution has the potential to change the proportionate ownership interest in SER. If Jacob elected the cash, he would be taxed on the cash distribution of $1,500. In either case, the distribution would be treated as a dividend to the extent of SER's earnings and
So I think here it's the mere presence of the ability to elect is what causes the gain to be taxed. Because think in a widely held scenario, not every taxpayer, not all the taxpayers are going to choose either cash or stock. Right? Some are going to choose one or the other. And so you're going to have a disproportionate change in the relative ownership of the corporation, and that's what causes the distribution to be taxed. If in this situation you had Jacob and Jenny, and you have two shareholders, you could go and ask them, like, do you want stock, do you want cash? And if they both say stock, then don't provide an option. Just do stock dividend on tax. If they want cash, just do cash. Don't give an option, right? But in a widely held scenario, you're never going to get 100% on one side of the choice versus the other. Okay. So on Monday, we're going to start stock redemptions. This is our last category. This is share buybacks, and that's another way to get cash to shareholders. This is a pretty dense area as well, so I would caution you to read this before we talk about this. But I will send a note out the next couple of days on what we're going to do.
And just give you the trade. Honestly, give me the trade. And it's gotten better.
So we're just, it's like some, like,
Yeah, okay.
it's like, we're on Friday or Saturday? We're going out Friday, not Saturday.
Like, there's just like a line at. There's like a line. There's like the one desk. Where it stops.
So we're going out next Friday to do
But that's the same revision.
Okay, bye bye, 加油 see you.
We'll walk there.有你传呢？
That's the way I do it.
I was not aware that I have.
Yeah, let us know if you are tell me because so that
Why don't I do nothing?
and also today